It's over. Not soon. Not eventually. It's over now. For years, we sat here doing the same thing, studying the charts, watching open interest balloon, tracking paper silver pile up against a physical market that kept getting thinner and thinner. And we all said the same thing. One day the banks will break. One day the naked shorts will get trapped so badly the entire financial system will be forced to bow. Until this morning, that was still theory, a probability, a math problem. But now? The guessing stops, because today the body has been found. While most people were glued to their screens watching silver trade around $77.16, celebrating the breakout and running portfolio math, something far more disturbing was happening quietly inside the machinery of the global financial system. Something the mainstream media doesn't want to touch, because it points straight at a truth they can't explain away. This morning, official data from the Federal Reserve Bank of New York hit the tape. Overnight repo activity, Friday, December 26th. And the number that appeared was not a typo, not a rounding error. It was a confession. More than $17 billion in cash tapped in a single morning, right after Christmas, by banks that are supposedly too big to fail. Understand what that means. This is not a place healthy banks go to borrow money. This is not growth capital. This is not business expansion. The Fed's repo window is the emergency room. It's the financial system's last stop before collapse. Strong banks borrow from each other. Weak banks go to the Fed. So ask yourself this: why would the masters of the global financial system need $17 billion in cash at 8 a.m. the day after Christmas? Not for payroll, not for operations. They needed it because they were bleeding. They needed it because they had just been hit with a margin call so large it threatened to blow a hole straight through their balance sheets. Connect the timing. Yesterday, silver gapped higher. Overnight, it surged into the $77 zone. These banks are sitting on massive short positions, hundreds of millions of ounces, sold at $30, $50, even $70, assuming they could always push the price back down like they've done for decades. But this time, it didn't work. Retail didn't sell. Industrial buyers didn't sell. Physical supply didn't appear. Price didn't fall. It went vertical. And every single dollar silver moves higher translates into billions in losses for those short positions. For months, those losses could be hidden, labeled unrealized, kicked down the road. But clearinghouses don't care about hope. They don't care about next week. They care about solvency today. When price moves violently against a leveraged position, the system issues a simple command: post the cash or we liquidate you. This morning, that command came due, and when the banks checked their available cash, they didn't have enough. So they did the only thing left. They gathered up their U.S. treasuries. They ran to the Federal Reserve. They pawned the last clean collateral they had just to survive the day. And here's the part that should make your stomach turn. This happened on a Friday, right after a major holiday, when nobody was supposed to be paying attention. Bad news always hides on Fridays. They hoped this would slide by as routine liquidity operations. It didn't. We saw it. And what this tells us is simple. The suppression machine didn't fail because of ideology. It failed because it ran out of cash. Before you shrug and say, $17 billion, that's nothing in today's world, you need to understand where this money came from and why it matters. This was not raised in the open market. This was not borrowed from peer banks. This was not confidence. This was distress. The repo facility is not a tool for expansion. It's not there to help banks grow. It exists for one reason only: to keep institutions alive when cash disappears. Think of it this way. If the interbank market is a dinner table where healthy banks lend to each other, the Fed's repo window is the alley behind the restaurant, where you sell whatever you still own just to survive the night. Strong banks avoid it. Weak banks rely on it. And when too big to fail, banks are forced to use it, it tells you something critical. They couldn't get the cash anywhere else. Now, here's the part most people miss. Banks don't fail because they don't have assets. They fail because they don't have liquidity. You can own trillions in bonds, derivatives, and promises, but if you can't raise cash right now, the system treats you as insolvent. That's how margin works. In leveraged markets, the question is never, are you rich on paper? The question is always, can you post cash today? This is why the timing matters so much. Silver didn't drift higher over weeks. It jumped. A sharp vertical move compresses time. Losses that might have been managed slowly suddenly become immediate. And margin calls don't negotiate. They don't care about reputation. They don't care how important you are. They care about numbers. When price moves violently against a leveraged short position, the clearing system recalculates risk instantly. If required collateral exceeds available cash, you have two options. 1. Produce cash. 2. Or get liquidated. That's it. The argument here is that when silver surged into the mid-70s, those calculations crossed a threshold. The losses stopped being theoretical. They became actionable. And that's when the banks realized something terrifying. They didn't have enough liquid cash on hand. So they did what desperate institutions always do. They grabbed the last thing the system still accepts without question, U.S. Treasuries, and ran straight to the Federal Reserve. Not to grow, not to invest, but to stop the bleeding. That $17 billion wasn't a stimulus. It wasn't easing. It was a tourniquet. A temporary clamp to prevent a forced liquidation cascade that could have detonated the market. And remember the calendar. Friday, after Christmas. Thin liquidity, low attention. This is exactly when uncomfortable truths are buried. Because if this had happened on a Monday morning, with full volume and eyes everywhere, the questions would have come immediately. So no, this wasn't routine. Routine doesn't happen at the emergency window. Routine doesn't spike after a holiday. Routine doesn't line up perfectly with a violent move in a heavily shorted market. This was the system reacting under pressure, and pressure reveals weakness. To understand why this situation escalates so fast, you have to understand leverage, not as a buzzword, but as a weapon that cuts both ways. In the silver futures market, one contract controls 5,000 ounces of metal, not paper value, real ounces. When a bank sells one of these contracts short, it is promising to deliver 5,000 ounces of silver in the future. But here's the trick that made the game work for decades. They don't need to post the full value up front. They only post a fraction, often 10 to 15%. That's margin. It allows a small amount of cash to control a massive amount of metal. It's how paper silver grew far larger than physical supply. And for years, this leverage worked in one direction. Price up, sell more paper. Price spikes, sell even more. As long as the bank could always meet margin requirements, the illusion held. But leverage has a dark side, because it turns small price moves into huge dollar losses. Let's keep this simple. One contract served 5,000 ounces. A $1 move marked $5,000 loss per contract. Now scale that to the size banks operate at. If a bank is short just 10,000 contracts, a conservative estimate in this narrative, that's 50 million ounces of silver. Now do the math. $1 move against them, $50 million lost. $5 move in a single day, and $250 million lost. And that's one bank, one slice of exposure. When silver jumped from the low 70s into the high 70s in less than 24 hours, these losses didn't accumulate slowly. They hit all at once. This is where the distinction between paper loss and forced reality matters. For months, losses can be hidden under the label unrealized. Executives go on TV and say, "We haven't closed the trade. The price will come back down." But the clearinghouse doesn't care about confidence. It doesn't care about reputation. It doesn't care about long-term narratives. It marks positions to market every day. When price moves too far, too fast, the system doesn't wait. It demands cash. And this is where the trap snaps shut, because banks don't keep unlimited cash lying around. They operate on the assumption that markets stay orderly. When volatility explodes, the math breaks their assumptions. At certain price levels, and the argument here is that around $77, that threshold was crossed. Losses exceed the daily liquidity buffers banks keep on hand. Risk models fail. Value at risk limits blow out. Internal alarms start flashing red. At that point, it's no longer a trade, it's survival. If the clearinghouse forces liquidation, short positions must be closed at market prices, which means buying silver into a rising market. That kind of forced buying doesn't slow price down, it accelerates it. This is why the leverage works like a spring, compressed for years, held in place by confidence and liquidity. And the moment liquidity disappears, the spring releases violently. That's why the banks didn't just accept the loss. That's why they didn't wait it out. They ran for cash. Because once leverage turns against you, there is no pause button. This is where the story stops being financial and starts becoming physical. Up to this point, everything could still be framed as numbers on a screen. Cash flows, margin calls, liquidity stress. But now we cross a line. Because the market stopped asking for money and started asking for metal. In the futures market, most contracts never reach delivery. They're rolled, netted, settled in cash. That's normal. What's not normal is when buyers refuse to roll. When they hold the contract to expiration and say, I don't want dollars, I want the ounces. According to the narrative we're following, that's exactly what started happening. Delivery notices exploded. Not thousands of ounces, tens of millions of ounces. Roughly 63 million ounces standing for delivery in a single month during a holiday period on one exchange. To put that into perspective, that's a meaningful chunk of annual global mine supply demanded at once. And here's the problem the banks cannot escape. The metal that can actually be delivered, the registered inventory, has already been drained for months. So now the system faces a reality it can't paper over. You can wire 17 billion in a second. You can print dollars endlessly, but you cannot print silver. If someone stands for delivery and the metal isn't there, the seller has only two choices. 1. Find physical silver in the open market. 2. Or default and cash settle. And both outcomes are catastrophic. If banks go into the open market to buy metal, they become forced buyers in an already tight market, buying at rising prices, accelerating the move higher. If they cash settle instead, the illusion breaks. Because once a single contract is settled in cash against the buyer's will, the entire market understands the truth. The paper price and the physical price are no longer the same thing. That's when confidence collapses. That's when futures stop functioning as a price discovery mechanism and turn into a promise nobody believes. And remember, the Fed can solve liquidity. It cannot solve delivery. This is why the $17 billion doesn't end the crisis. It only buys time. Time doesn't create metal. Time doesn't refill vaults. All time does is allow demand to keep arriving. And as price rises, demand doesn't fall. It increases because buyers realize supply is running out. This is the inversion that breaks markets. Normally, higher prices reduce demand, but for a strategic asset in shortage, higher prices signal urgency. That's how a financial problem turns into a physical one. And once it's physical, no central bank can fix it. This is the moment many people misunderstand. They hear, the Fed stepped in and assume the crisis is contained. But in this story, the opposite is true. Because the Fed didn't solve the problem. It locked the system into a feedback loop it can't escape. Here's the contradiction. The banks were in trouble because silver was rising against the dollar. Their short positions were bleeding as the currency lost purchasing power relative to a hard asset. So what was the solution? Print more dollars? Inject liquidity? Flood the system with cash. That action keeps the banks alive, temporarily. But it also devalues the dollar further. And what happens when the dollar weakens? Silver goes higher, which means the short positions get worse, which means the margin calls get larger, which means the banks need even more liquidity. This is the trap. Every bailout increases the pressure that caused the bailout. The Fed can print infinite dollars, but it cannot print a single ounce of silver. So every time the Fed intervenes, it strengthens the very thesis driving demand for metal. This is why the narrative says the dynamic has changed. Before, the fight was market versus bullion banks. Now it's market versus the central bank itself. And even the Fed has limits. Not legal limits, mathematical limits. You can sell infinite paper contracts, but you cannot post infinite margin cash without destroying the currency those margins are denominated in. This is where the suppression mechanism breaks. For decades, rising prices were capped because shorts had unlimited paper ammunition. But ammunition requires cash. And once liquidity dries up, paper stops working. This is why short sellers begin to disappear. Not because they suddenly turn bullish, but because shorting silver in this environment becomes financial suicide. When volatility explodes and the Fed is forced to print to save the system, there is no edge left on the short side. So the shorts don't fight anymore, they retreat. And when shorts retreat, something dangerous happens. The market loses its ceiling. Price rises without resistance. Sell-side liquidity vanishes. Every uptick finds fewer sellers and more urgency. This is no longer a squeeze driven by panic covering. It's a vacuum. And vacuums don't move politely. They jump. That's why, in this framing, price targets like $80 or $100 stop being speculation. They become outcomes of policy because the Fed has made a choice. Save the banking system, even if it means sacrificing the currency. And once that choice is made, hard assets don't need a catalyst anymore. They just need time. This is where everything comes together. At this point, this is no longer a trade. It's no longer even a market event. It's a regime shift. The shorts are gone. Not because they were defeated emotionally, but because the math made their position impossible. The banks are still standing, but only because they're being kept alive by emergency liquidity. And that's not strength. That's life support. And institutions on life support don't control markets. They react to them. The Fed has effectively placed a floor under the system, and in doing so, it has placed a floor under silver. If silver drops, the physical shortage remains and the squeeze rebuilds. If silver rises, the banks bleed and the Fed prints. Either way, the response is the same. More liquidity, more currency dilution. This removes the downside risk that usually scares capital away, and capital understands that. That's why the focus shifts from charts to positioning. In this framework, the real divide isn't bulls versus bears. It's paper versus physical. Paper can be created instantly. Physical cannot. And once confidence in paper breaks, once even one forced cash settlement occurs, price discovery moves off the screen and onto the street. That's when premiums explode. That's when availability disappears. That's when the buy button vanishes. At that point, price becomes almost irrelevant because you can't buy what doesn't exist. This is why the story ends where it began, not with speculation, but with evidence. A sudden repo spike, a violent move in silver, record delivery demands, a central bank forced to intervene in silence. Taken together, these aren't random data points, they're signals. Signals that the old system, built on leverage, confidence, and endless paper, has reached its limit. What replaces it won't arrive with an announcement. It arrives through shortages, volatility, and repricing. And in that transition, wealth doesn't disappear. It moves. From promises to things, from leverage to reality, from paper to metal. This is the end of the old playbook and the beginning of a new one.